As an accounting student in your very first lecture, you probably had some required readings that you actually didn't do, and thus was confused when the lecturer started talking about accounting principles. So let me break it down for you. Before we begin listing and explaining each accounting principle, let's understand what they actually are. Accounting principles are rules or guidelines that companies must follow when preparing their financial statements. They are a part of the generally accepted accounting principles and are enforced by the Australian Accounting Standards Board. There are three main principles and several other accounting assumptions and qualitative characteristics. One of the three main accounting principles is the revenue recognition principle. A revenue is an increase in resources as a result of a sale of a good or service. For example, when you wash your neighbor's car and he gives you $15 as payment, you have earned a revenue of $15. The revenue is then recorded according to the revenue recognition principle. This principle tells us that revenue is to be recognized only when it is realized or realizable and when it is earned. This means that businesses shouldn't wait until the revenue is actually received to record it into the accounts. This is a key concept in the acro basis of accounting. Revenue is realized or realizable when goods or services are exchanged. It is earned only when all the requirements of the transaction are met. Again, for another example, Pedro's Pencils sell 500 pencils to Kelly's kindergarten for $500 on the 30th of May. The pencils were not paid for until the 15th of June. According to the revenue recognition principle, Pedro's Pencils should record the revenue in May because the revenue was realized and earned in May, even though it was not received until June. So now that you know what an accounting principle is, you're probably wondering, what's the big deal? Why do I need to know this? Why is it so important? First, with accounting principles, there is a lesser leeway and margin for error when businesses are preparing their financial statements. Second, when the information presented in the financial statements are accurate, the business is given insight on their performance during the financial year. Third, with the accounting principles in place, financial statements from businesses in the same industry, regardless of the type of entity, are easily comparable. The comparability makes it a whole lot easier for investors to evaluate businesses to decide on which company to invest in. So that's what accounting principles are, the revenue recognition principle, and why accounting principles are important in under 3 minutes. Now you know.
Created using Powtoon.